All right, so welcome. It's an honor and privilege to have Michael Moseby here to talk about pre-qualifying to buy a property. Michael, why don't you introduce yourself briefly?
No problem. Yeah, Luis, first, it's an honor and a privilege to be on with you. I followed you for a long time, and I'm glad we're able to do this. I'm glad you kind of pushed me out of my comfort zone a little bit to do this. So thanks a lot for that. My name is Michael Moseby. I've been in home finance for over 20 years. I've been originating loans for about 8 years with New American Funding my whole career. It's a great direct lender. And in 2020, I was top 1% loan originator in the country.
Wow, top 1% of the country. That's amazing.
Mm-hmm.
So we'll have to ask you more questions about that, how you did that, what that. Well, right now we're just showcasing a property for sale in Palmdale. It's on the market, 3 bedroom, 3 bath, 2,000 square feet. It just came on the market like about a week and a half ago. So we're talking for basically for people who are new to have never bought a home, who don't know much about purchasing a home, or reviewing for those people who pretty much are not, don't know much about the home buying process. So let's go over that for them, and so let's just make this very basic for those individuals. So how does one go about, because the home can cost, the median home is over $800,000. In our lifetime, it's going to take a long time to build up that amount of money, or maybe someone will never in their lifetime. So how do you go about getting a loan, applying for a loan for a home?
Yeah, it's a good opening question. Just on a very general level, 800,000, you're absolutely right, is the median home price, but the entry level home price is a little lower than that. 600 to 650 can get you in the door in most neighborhoods. So even that compared to 10 or 15 years ago, equity has almost doubled for home owners. And that's what I talk to a lot of the people who are in that situation about, who are currently renting or who haven't owned a property for a very long time. I talk to them about the historical kind of value of homes. Yes, it's high right now. It's gotten higher for homeowners. And really, at what point are they going to become a homeowner and start building that equity? The pain of getting pre-qualified, buying a property in the current market, there is a lot of pain there. And I see that from the buyer's perspective. I try to paint the full picture of what is the pain of not buying. What is the market going to look like 5 years from now, 10 years from now, based on the history of the movement of property values. And I just lay that information out, So the short answer, to qualify, there are three main buckets, a little checklist that the lender needs to go through. The two kind of that aren't super important that people don't know about is that you don't need perfect credit. Your credit score that a lot of people are worried about does not need to be 800. It doesn't need to be 700. I've financed, throughout my career, about a dozen clients with lower than a 600 credit score. So there are loan programs out there with people with less than credit, less than perfect, and even poor credit. There are loan programs out there. 620 is about the median credit score you need from your three credit scores, the middle one, in order to qualify for most good, FHA, first time home buyer program. So 620 is the minimum credit score. Down payment is also not a big deal. People think they need 20% down because they read something online. And for a $600,000 home, that's $120,000, which nobody has like in their account. So really the minimum down payment for most loan programs for first time home buyers is in between 3 to 3.5% based on their credit score. So now when you're talking about that $600,000 home, you're talking about $18,000, $20,000 for the down payment, about $10,000 for closing costs. So $30,000 between your checking and savings, your 401k, and any family gift is attainable. So those first two out of the three qualifications, FICO score and down payment, are not huge hurdles for most renters. What is a pretty big hurdle is to make enough money to make the payment and you still be comfortable. That's a big pain point right now in the market, especially if you looked at buying 5 years ago or you looked at buying 7 years ago. And I plugged in these numbers a little bit ahead of time. I don't know how deep you want to get into them, but for a $650,000 home coming in with that minimum down payment and having average credit, the monthly payment on the house, including property taxes, is about $5,000 a month. which means you and your spouse or you and whoever you're going to buy with, or if you make pretty good income, you need to make twice that amount, 10,000 a month.
Okay,
So
let's just let me just back up right there. So
sure.
what I heard you say is you need to have a credit score of about 620 or above. So if I want to buy a home, I need to have a credit score 620 above to qualify for a home loan, typically. And then I need to have a down payment of 3 to 3.5%. And so what you're suggesting is about a 650 home purchase. You need about $20,000 for down payment, and then you need to down pay the closing costs, another possible $10,000, and that's for down payment. Now, if I have a low credit score, let's just say I had some issues come up in my life and my credit score is low, what can you recommend to me to
Right.
improve my credit score so I can be ready, qualify?
Yeah, that's a great question. That's a great question. A lot of people do have less than that credit score, and a lot of them do eventually end up being home buyers. It's the same answer to that question, which is the answer to the question, why do I need to get pre-approved? Why do I need to show you my pay stubs? Why do I need to show you how much money I have in the bank? Because you want to know, as the client, where is my credit actually? Because what the free credit score that you pull up on Credit Karma or at your bank app or at when you go to open a gas card at Chevron, that credit score does not necessarily equal the credit score when you're taking out a $600,000 loan. When the banks and the credit formula is a little bit more conservative when we're pulling a mortgage credit score. It's a little lower. So you really want to take a fair and accurate look at your credit. To answer your question specifically, you want a lender to run your credit. If you think your score is bad, you want a lender to run your credit, which will give you all 3 credit scores for free. There's no cost. There's no obligation. It's absolutely free. And what I like about my company is that not only do you get a free copy of your credit report if your credit is less than 600 or less than 550 and it's not financeable. It's really my job to let you know, okay, on a very simple level, here's the amount of credit card debt you need to pay down to increase your score as much as possible. That is completely free. It's called a credit improvement report.
Okay, so what I heard was, let's just say I have with AAA, I have auto credit monitoring. So I can look at my credit score on AAA and I can see my credit score. And you're suggesting that I run my credit through a lender, right? To see what the lender says is my credit score, which may be different. So how would that work? Let's just say I want a lender to run my credit. How would we do that?
No problem. So you want to get connected probably through the real estate agent that you want to get connected to a legitimate, lender who's going to, take time with you, follow up with you, because credit improvement does take a few months. My best friend who bought his property 2 years ago, he had to go through 2 rounds of credit repair that took 2.5 years. So you do want someone who's committed through the long haul, not just running your credit. Oh, you have bad credit, call me back when it gets better. You want to be connected to a lender that's there for you to get you to that credit score that you want to qualify for them. That's the first step. But yeah,
so then let's say I call you. I would give you my information. You'd run my credit, and then what I just heard you say is you'd actually give me the report.
Absolutely. I give you a secure copy of the report. I'll email a secure copy of the report that blacks out your social and your account number, and we go over that. We go over the first step, which is, hey, your credit score is a little low to qualify. Here's what you can do on a very simple level to pay down credit card debt. Here's how much credit card debt you need to pay down. And here's the improvement to your credit score. That's the first step. If that's not enough, and the credit score is still too low, then you need to go to credit repair. And there's several credit repair companies out there, one of which I work with. And then they will work from 3 to 6 to 12 months to delete collections or dispute lates or try to, work on the bankruptcy that's there. They work, they're not affiliated with my company. They work to delete negative information and dispute negative information. And they charge kind of in the ballpark between $100 and $200 a month over months, which for some people it's needed. The possibility of building hundreds and thousands of dollars of equity to spend $1,000 or $1,500 on credit repair seems like a good deal.
Okay, so that was my question is what factors affect credit, And you said delinquencies or
Mhm.
collections.
Mhm.
What else could negatively late payments? Those are things
Absolutely.
that
Yeah.
can make my credit score go down, right?
Absolutely. Yeah. The two answers to that question. Number one, the thing that affects your credit the most is recent negatives. There can be a 30-day late or a 60-day late that's 5 years old, and you can have an 800 credit score because you haven't done anything negative in that time. Or you can have a 60-day late on a credit card that's from last month, and it's going to drop your score by 100 points. So the
Okay.
recency of the derogatory has a lot to do with the credit. The second answer is what I see a lot of people with poor credit do is they'll have a couple of lates, they'll have a bad season in their life, and they'll make a couple lates on their bills, and they'll say, you know what, I can't do credit. I'm just going to stop doing credit because I make my lates and I don't want to open any other credit. I'm going to close all my cards because obviously I'm not good at this credit thing. And then 10 years later, we run their credit and they have these collections on there and they haven't opened any positive credit in the meantime, and they have horrible credit. The right thing to do if you have a late or if you have a collection is to deal with the collection, but continue to open positive credit, continue to open credit cards. Don't have the balances too high, make those on time, get a car loan if you need it, make those payments on time, take out a personal loan from your bank if you need it, make those payments on time. So you start to build a lot of positive credit to counteract the negative credit, and that builds your credit score higher.
Okay. So I heard you say, just to review, pay down my defaults or my don't have pay my things on time, don't have any late payments, my loans, my car loan, pay it on time. And if I don't have credit cards, it's a good idea to open up some credit cards, and then just use it and pay it. Use it and pay it down, pay it on time. And that way that's going to build my credit.
Right.
Right.
Right. Yeah, absolutely.
Okay. And then so I would call you, you would run my credit, and then you would go over these things with me, help me to understand where I need to be at, and hopefully rerun it again, improve it if it needs to be. And then for the down payment, how would how would you know that I had the down payment? What would I need to show to?
Yeah, I mean, a lot of this is personal information, which we've talked. This is the second time we're talking about this. It's a little painful to disclose that. It's a little painful to, and I have had clients who do have a lot of money in the bank, and they only want to give me one or two of the accounts, which is fine because I can only put on the application that you have these one or two accounts. The loan amount's going to be kind of high because you only told me you had $20,000 in the bank, and you didn't allow me to let you know, hey, if you wanted to spend $100,000 that you have, it'll be a much lower payment. So it's kind of a good idea to go ahead and disclose everything you have to the loan agent so they can say, hey, here's what minimum down payment looks like if you want that, and here's what a higher down payment looks like. It's your choice.
Okay. So I would be giving you over my bank statements, right? So that you could review and verify that I have the amount necessary to put for down payment. So would that be, I would email that to you, or can I just take a screenshot and text it over to you, or how can I get you my info?
Both of those are legitimate ways. The two ways that I prefer is to fill out an online app, and then at the end of the online app, there's a secure link that you can upload the documents to, because most people have their bank statements on their computer, and it's very easy to attach to a website, the secure website. Emailing them is fine as well. I've closed, hundreds of transactions. I've never had clients, stolen. Our email server is very secure. Texting is fine. The problem with texting is that once I finish reviewing the file and your documents and tell you that you're approved, and then you find a home, an underwriter is going to need to review these same documents. I can view the documents very easily on my phone, but when they get uploaded in our system, they're a little blurry, and now we need to go through you emailing me them. Just emailing a clear copy is easier. But for pre-approval, if we're trying to hurry up and just go find a home this weekend, you can go ahead and text me the documents.
Okay, that works. So you're gonna run my credit. I'm gonna get you my documentation for my bank statements or my proof that I have the funds to be able to buy the home. Can I use my retirement accounts, or is that something that I can use?
That's what a lot of people don't know. Yeah, I mean, people look at their checking and savings and they're like, man, I don't have enough for the 3 or the 3.5% down on closing costs. You can use your 401k, stocks and bonds, any IRA, and you can use family gift. for any purchase of a home loan using when you're buying a primary residence. If you buy an investment property, you can't use gift funds. But for FHA and Fannie Mae, they allow family gift towards the closing cost and towards the down payment, whether the family member is living with you or not.
Okay, so let's just say my parents or my in-laws are going to give us some money to be able to put down. Do you have to run their credit, or do they have to?
Good question. Good question. No, they don't. If you have good credit, meaning over a 700 credit score, you probably qualify for Fannie Mae. And that only allows the family member to fill out a one-page letter that says they're gifting you $5,000 or $10,000. You sign the bottom, they sign the bottom, and that's it. They wire the money into escrow. Once we find the home, it's very easy. If you have less than a 700 credit score, usually you have to use FHA. They do require to look at the family member's bank statement in addition to the gift letter, but we don't have to run their credit. They're not on the loan. We don't need to put them on the application at all.
Okay, and then do they have to give you their bank statements as well to show that they have the money, or?
Only for FHA, yes. Only for FHA. If you have over a 700 credit score, all they need is to fill out the gift letter and then wire the funds to escrow, not transfer the funds to you, because if they transfer the funds to you, we do need to see their bank statement. So I advise my clients who are using gift funds just to fill out the gift letter and wait for the family member to wire the funds into the escrow company once we find a property.
Okay. And just you know, that's the minimum requirements. But for those out there, you know, when you are submitting an offer, because I am a listing agent and we do receive offers, if when we have an offer from a buyer and it doesn't have the proof of funds, meaning you say that your father or your in-laws are going to give you the down payment, they're going to give you down payment. We're not going to accept your offer. You literally have to show us the down payment, the actual funds that they're coming from, and the letter. So that's at that point when you're going to submit offers, you need to have the proof of funds for us to consider it. That's just you know, a seller doesn't want to take their home off the market unless you're really ready to close escrow. Okay, so then how about the income? You said income was a factor, so
it is.
How does that work?
No problem. So the two buckets of income that are most common are W-2 employees. When you work for a company, let's say you work for the school district, or you work for the county, or you work for AT&T, you get a pay stub. So I can see very clearly that you make $30 an hour and you work 40 hours a week and you have a little bit of overtime. So I can plug that into the system. That equals, you know, $5,000 a month before taxes are taken out. And then your spouse, they have a very similar job. They make about $5,000 a month because their pay stubs say that as well. That's a very kind of cut and dry thing that we look at. Pay stubs, W-2s. We don't need tax returns because you don't own a company. So we just need that as long as you don't own any other property. So it's very, very simple for a W-2 employee. That's the first bucket of how to look at income. The second bucket is a little.
So what I would do there is you would email me a link, and I would upload on the link my pay stubs and my W-2. Is that correct, or would I?
Correct. Yeah. So all of this is dependent upon the answer to all these questions is dependent upon the initial consultation that you have with me. When we first speak on the phone, it takes me about maybe a half an hour, 45 minutes to discern, here are the programs that it looks like you're qualified for, and here's a list of the documents that I think I'm going to need to confirm all of this info that you told me verbally on the phone. So I'll email you a complete list of the documents that are needed. Then you can fill out the online application and attach the documents that are needed so that you're not having to send over documents that aren't needed.
Okay, so we'll have a consultation over the phone, or potentially in person or on Zoom, and then we'll discuss the situation, and then you're going to tell me, okay, submit these documents, and then we'll get the documents started. Okay.
Perfect.
That's right. Okay, so W-2 is pay stubs and my
W-2s.
W-2. And how about if I have my own business, or I'm
yes, that's a little bit more complicated. So really, when you own your own company, everyone understands why you own your own company is that you have a huge tax benefit that you can make a certain amount of money during the year and write off expenses when it's time to file taxes. It's totally legal. And say that you took home, or you netted less income than you might have actually brought home on your bank statement. So that's very good. On a year-to-year basis, you use the tax code to own your business, file your taxes, and not have a big tax bill or a big tax exposure. The problem with that is when you come to the lender and you tell the lender, hey, I made $100,000 last year in my company, and on the tax returns, it only says you made about 30 because you wrote off all your expenses. I can only put $30,000 for the yearly income on my application, which is, as we discussed, kind of not enough to get an entry-level property by yourself. Obviously, if there are co-borrowers, that's totally fine. We can use co-borrowers info. Another income that we can use as well is a family member who doesn't live in the area, who doesn't have a lot of debt. That's a non-occupant co-borrower, a family member that lives out of state who is comfortable with going on the loan and me running their credit. We can use their income to help you qualify. We also need to look at their debt too. So just because they might make a lot of money, they might have a lot of debt and not be able to help you. But that's all to kind of center around the difference between a W-2 employee that's very simple, and we look at pre-tax income, what you make before they take the taxes out of your paycheck. But for a self-employed person that files income on their tax returns, we have to look at the net, because you're telling the IRS, even though I made 100,000 this year, I had 70,000 of expenses, which only left me with 30,000. Well, I can only put 30,000 on the application. Any lender can only put what's actually on your tax returns.
Okay. And so this is in my business. I've been in my business and working my business, and I have my income, my tax returns, and I've been showing low. And now let's just say I want to qualify for a home, so I'm going to show higher my tax returns. How many years do I have to show the higher income that is going to be considered for my home loan?
Right.
Let's just say in that scenario, 30, I have like 2 years of 30,000, but now this year I want to show 150,000. How many years of 150,000 do I have to have in order to qualify?
That's a very good question. The answer is either 1 or 2 years.
Okay.
2 years is usually what's needed, especially if you have less than a 700 credit score. 2 years is usually what's needed. And you not only need to file the higher income, you actually have to pay the IRS as well. We're going to check to see that you paid the IRS and you're not just putting on your tax returns that you made more and then changing it later. So you do need to pay the IRS for that additional income. Usually it's 2 years, especially if you have less than a 700 credit scores. But if you have over a 700 credit score and you're putting at least 10% down on the sales price, Fannie and Freddie allow for a 1-year tax return program, which is great at this time of year to talk to a lender if you are a self-employed person that doesn't file the income that you actually make, to consult with the lender to say, hey, I'm looking to buy a 600 or 700 or whatever $1,000 house I'm looking to buy. I actually do make this amount. What should I file, for 2023? Is this enough, or do I need a co-borrow? It's a great time of year to talk to a professional about that.
Okay. So what you're suggesting is, let's just say I have my own business. I want to buy a house next year. So I should show my income on my taxes. But you're suggesting maybe you can help me. You can look over my file and you can guide me as far as what I can put on my taxes so that I qualify for the home. Right?
Right.
Is that what you're saying?
We'll have a discussion about what you're actually taking home, because what I don't want to do is to say, hey, you need to file this amount of money. You're not actually making that amount of money. Then the mortgage payment doesn't get made. That's not my job. My job is to only give you what you can actually make. My company and I stay in business by only giving out enough loan where the monthly payment is feasible for the buyer. And just to dig a little deeper, it's usually 50%. If you're making $10,000 a month of income, any bank is really only going to want you to have $5,000 a month of total debt, because obviously you have insurance and you have food and you have gas and you have all these other expenses that we're not looking at. So they really only want you to have half of what you make in total to be your total debt, including any debt on the credit report and the upcoming house payment. And that keeps everyone not having to foreclose on their properties and not having to be late on their mortgage. It's been a really good formula for us to keep the bank safe and keep the homeowner safe.
Okay, so what I heard is if the family or individual makes $10,000, they would qualify for a monthly payment of debt payment of $5,000. So
Total
if it's
debt,
if, it, if
correct.
it's a, if it's a multi-gener, let's just say a group of people make $15,000 together, they would qualify for a $7,500 debt payment for a bank.
Correct, including any
Okay.
car loans on a monthly basis, car leases, any student loans, any minimum credit card debt.
Mhm.
Yeah, that's what's
Okay.
included, including the
Okay.
upcoming house payment. And that's kind of how I figure out when I'm talking to somebody, what do they qualify for?
Okay.
I take the total income and take about 50% of that. I back out whatever monthly debt they have on their credit report, and then I let them know, hey, here's the most expensive house you qualify for. A lot of times the people don't want to buy at the top of their market. They want to work their way down, which I'm more than happy to let you know, hey, you only
Okay.
want a $3,000 payment, not a $5,000 payment. Here's what that house looks like. Here's the sales price on that house. And then they go out with their real estate agent, with you, to find out, can we find something in that price range that we're happy with the price of the house and the monthly payment.
Okay. Now, what number of people heard say, I'm sure you get this a lot, but I've heard this a lot. And so I'd like to hear your responses. I don't want to run my credit because then my credit score is going to go down and I'll be all screwed up. So I don't want to run my credit till I'm 100% sure that I'm ready and I want to buy this house that I see right here.
Mm-hmm.
I don't want my credit score to go down. What do you say to people who feel that?
Yeah, I mean, again, I understand. I'm a person who I don't like my credit score run all the time. So I get it. It is a good idea to have a hard inquiry on your credit once a year, just to see what's on your credit, to see that there's no funny business going on. Now, I did say one hard inquiry all the time. You can have a soft inquiry, which I can provide to you, that will give you 1 out of the 3 credit scores that will show up on your mortgage credit report. It gives us a general idea of where you stand, and it gives a general idea of how much debt shows up. A lot of times I'm not 100% comfortable with them going and looking at property, because something could show up on the other 2 credit scores, and I'll always let the real estate agent know, hey, I'm finished with the pre-approval. They only wanted me to do a soft inquiry. If you want to show them properties, that's fine, but we can do a soft inquiry. That's fine. Now, if you think you have credit issues, I would definitely encourage you to do a hard inquiry, because you're not going to know how bad your credit is, and you're not going to know how to make your credit better without a free hard inquiry. You're not going to know.
Okay.
Yes, it'll drop your score.
Okay, so let's slow down. So a hard inquiry is where you run all 3 credit bureaus at one time, and you recommend out a hard inquiry 1 time per year.
Yeah.
A soft inquiry is where you run one of the credit bureaus. And how does that affect your credit score though?
It doesn't affect your credit score at all.
How about the how much does the hard inquiry typically affect your score?
It depends how much negative you have on your if you have a lot of negative and a lot of current inquiries, it can drop it by tens of points. Usually a hard inquiry drops it by less than 5 points. So
5 points,
it
okay.
almost is negligible, unless
Okay.
you're having your credit run several times, which is an indicator to Equifax and Experian and TransUnion that you're getting declined left and right and just hoping someone finances you. Well, that's a red flag. They're going to drop your score by having your credit run 10 times in 60 days. That's not a good idea. But to have your credit run once and lose a couple of points, the cost benefit of that, the cost is you lose a couple points. The benefit is you know exactly what's going on with your credit, and you know exactly how to fix it. That seems like a pretty good trade-off to me.
Okay. So you learn about what your credit score is, you know if you're qualified or not, or you learn how to fix it. And the soft inquiry, you said, doesn't decrease your score much at all. It doesn't have that.
Correct. It doesn't
Okay.
affect it at all.
Okay. And then just out of curiosity, the soft inquiry, the hard inquiry, you said 1 time a year. The soft inquiry is a certain number of times where it's okay. Or how many times would you do?
You can as often as you want. I mean,
Right.
it doesn't provide a full picture, and only 1 of the 3 scores come up. So, you know, it gives you a ballpark. It lets you know which ballpark you're in. It doesn't let you know what seat in the ballpark you're in.
Okay.
So you're not going to know exactly where you're at.
Okay. So a quick summary of what you said so far. We're gonna run, if I'm applying for a home loan, you're gonna run my credit, possibly a softer inquiry, possibly a harder inquiry. I'm gonna have to provide you my proof of funds that I can actually purchase the property, or or have a gift of the down payment. And then I have to show my income, my W-2, my pay stubs, or my 1099, or my tax returns if I run a business. Right? Okay. So we're running out of time here. And so on another time we'll talk about down payment assistance programs, but there's a lot of talk, a lot of questions, information from the state. Can you give us a little preview? Is this down payment assistance? Is it really something that's real, or is it a catch? Can you give us a preview of another conversation we'll have?
Yeah, well, it has a lot to do with I think it dates back to the no cost refi. Like in the last 5 or 10 years, everybody wants a no cost refi, and they're changing the verbiage of that because it was not accurate. There is no cost transaction. You don't get anything for free. So what they usually do, the down payment assistance program, state funded or private funded, is they'll increase your interest rate, because interest rates are based off of risk. And when you go in and buy a house and don't come in with a down payment, it's much more risk to the bank. So they'll increase your interest rate by about 1% to 1.5% higher. So if today's rate is 7%, which close to is, most down payment assistance programs are over 8%, which is not a huge difference. It could be at the price range we're talking about. It's about $500 a month to $600 a month higher payment. And it's up to you. We go over when a client does call me and say, hey, I don't have a lot of down payment. I might not even have enough for the minimum 3.5% to 3% down. Can you tell me about down payment assistance? Absolutely. Here's exactly what it looks like. You have to come in with far less cash to buy the property, but your monthly payment is higher by X amount of dollars. So you're going to qualify for a less expensive home. Which avenue do you want to go at? Here's what both avenues look like. If you were my cousin or my friend, I would recommend going down this road because it looks like this is best for you and your family, but all these roads are open for you.
Okay, so we'll talk about it further. But what do I need to qualify for down payment assistance? Is there any certain thing that's needed? Just what's the main thing that we?
Yeah. So down payment assistance usually requires slightly higher credit scores. So 640 for CalHAFA, that's the most commonly used down payment assistance program. So 640 credit score, and that 50% debt to income ratio that we talked about previously, where if you make 10,000 a month, you can have 5,000 of debt. They don't allow you to qualify for that much. It's usually about 4,000 to 4,500 in debt. So they don't want you to have too much debt because, again, you're not coming in with a down payment.
I see. Okay. All right. Well, you've definitely answered my questions about the home buying process. If anyone watching here has questions about the home buying process or the home pre-qualifying for a home mortgage, definitely reach out to Mike. We'll put his information in the description. Reach out to myself. Questions you have, you can put in the comments. No obligation. Reach out to us. So thanks, Mike. Thanks for coming on here today. You provided us much information. Look forward to other sit downs where we can talk further about in more depth about these issues.
Looking forward to it, Luis. Thanks so much for having me, man.
All right. Have a good one. Take care.
You too. Bye-bye.